Welcome back. Let's talk about what to do when the stock market goes down. The critical reason why you need to learn this is to not panic, maybe even cheer or be glad when the market takes a nosedive, because you're not losing money. You'll actually profit from this volatility. So I want you to be able to transform your thinking to understanding and accepting that the world isn't about having to read the Wall Street Journal every day. There are certain action steps that I'm going to give you toward the end of the video that can help you take control of your future instead of just the whims of the markets or natural disasters, the things that cause the market to whipsaw. So I'm Doug Andrew, and I have learned these valuable lessons through the School of Hard Knocks. And I've realized that sometimes the stock market or the real estate market is going to go through these gyrations. You don't panic. You actually accept and even embrace those opportunities. So one of the key things that I've learned is that when the market takes a nosedive is not to lose, and I'm going to share how to do that, but also to look for the opportunities that may come from that. For example, I've had many people that when the market took a dive down, their stocks, the shares were at a lower price. And there were strategies that we could employ to sell and get away with paying less tax or converting or getting the taxes over and done with by taking advantage of a low market. This is true with the real estate market and the stock market. So there are many times when the market takes a nosedive, it creates new opportunities. See, when there's anxiety, there's opportunity, as my good friend Richard Rossi has always told me. When we talk about the situations people get into, many times they just panic and they see that when the market is volatile and it takes a nosedive, that they are frustrated. What am I going to do? If I liquidate, I'm going to have to trigger and pay some tax, or I'm going to have to now accept this, because we have this mentality that I gotta wait until the market comes back up to the highest water mark it was at, or my house is worth the highest value, because we know the greatest it was worth when things were going great. Well, there's a lot of things we can do when the market goes down to be able to seize those opportunities to sort of reset. So I want to share with you one of the concepts that I've employed to be able to lock in my gains when the market's up, but then reset when the market goes down and not lose, and then start making money again from a lower point instead of trying to pick up where I left off. Because people who try to wait till it gets back to here don't start making money again until after they get back what they lost. If I don't lose it when it drops even 40%, I start making money again from the second it turns around. So let me give you a glimpse of how to do that. So I was responsible for over 3,000 clients in about 1980 in 13 Western states. They were never happier than when I got them out of the market, where they saw that whipsaw back and forth. We had a huge recession in 1980 and it clobbered them. And I provided some safety for them. So that is when I began to employ safer financial vehicles and strategies, because the key is to learn that it's in the strategy, not in the commodity. So let me use a metaphor here. If you were going to be playing in a golf tournament, let's say, and you had the choice of using a professional golfer like Phil Mickelson's swing, or you could use his clubs, what would you choose? Well, I'd rather have the swing, not his clubs. I've noticed that most financial advisors seem to focus on the clubs or the commodities. Buy this stock or this bond or this mutual fund or gold or silver. Do you know it's not in the commodity? It's in the strategy. It's in the swing. And so I learned the swing of indexing. Now, I'm going to introduce what it is. If you want to learn more, you can view some of my other educational videos or maybe even read one of my books where I go very deep into indexing. But that is where I get my money out of the market and I'm earning a very safe rate of return with some very strong AAA rated financial institutions that have weathered the Great Depression, big insurance conglomerates and companies. And anytime I feel bearish about America, that the economy is going to be rough, I can just hunker down and settle for their general account portfolio rate of 3, 4, 5%. Some years that's as high as 8 or 9% in my history. But if I feel bullish about America, I think the next year is going to be better, then I can link my returns to an index without losing if the market goes down, because all I'm doing is I'm taking the interest I'm earning on my money. Let's say I have $1 million accumulated. And if I'm earning 5% interest, I can take that 5%, which is 50,000, and tell the institution, you know what, do whatever you need to do with that 50,000 to let me participate with the upside if the S&P or the Dow Jones, if the market goes up. If the market goes up, they have the wherewithal to pay me 8 or 10%. But if the market goes down, those options expire worthless, but I still have my million. See, in 2008, when many Americans saw, let's say, $1 million drop to 600,000, I may not have earned a dime in 2008, but I didn't lose. I simply gave up the interest that I was earning on that bought options. But the first 90 days of 2009, I was able to lock in a gain of 16% because I lock in the gain. So let's go to a good year. In 2017, many people following what I'm teaching you experienced 16% gains using indexing, some as high as 25. The next year, it didn't go as well as that. But see, if the market had lost 40%, they would have not have lost the 25% they made the year before. They might not earn anything in 2018, but they didn't lose the 25% they made in 2017. And so as Will Rogers once said, when things get bad, people are more concerned about the return of their money instead of the return on their money. And so let's go back to a metaphor I like to use, playing red light, green light. See, by using indexing, I made money 5 years from 2000 to 2010, okay? I was taking positive steps forward in the year 2000, but 2001 and 2 and 3, nope. But I didn't lose 40%, I earned 0. Then 2004, 5, and 6, I took positive steps forward. 2007, I didn't lose 40%. I didn't make anything through 2008. But in 2009 and 10, I took positive steps forward. So I never had to take any steps back. I never had to wait to make up the losses because I don't lose. So this is the power of indexing, and when the stock market goes down, you want to take advantage of the lock-in of your previous gain, which you can do every year, and you reset, because it's way easier when the market drops from here down to here to start making money again from this starting point instead of where you left off. In order to understand how to do this, I would encourage you, click on this link here. In fact, I would love for you to get a free copy of my book. I think you just pay shipping and handling, and you can do that. And you can learn and study how not to lose and actually take advantage of market volatility when the stock market goes down. So if this is sounding a little overwhelming, I understand. This is why I wrote and released my 11th book. It's actually 2 books in one, The Laser Fund. This has 14 chapters with all kinds of charts and graphs. And if you study this, you'll be able to really understand indexing and lock-in and reset. If you're more right-brained and you like to learn by stories, you flip the book over this way. And this has 100 pages, 12 chapters with 62 chicken soup for the financial soul stories of how this really works in real life. Now, I want you to have a copy of this. I'm going to gift you one free. If you would like, just cover a nominal shipping and handling fee, and you can click below and obtain a free copy of the Laser Fund to empower you to understand these strategies.